Okay, where's everybody from here? Let us know where you're watching from. Let us know where in the world you are watching us today. Miami, Brooklyn, Alabama, Kansas, Singapore, India, Seattle, California, Phoenix, Argentina, Dubai, Chicago, London. It's worldwide here. Canada. That's great. Okay, well, let me just give you guys a brief introduction here. Okay, Florida, I like that. Here we have Matt Maley, the one and only. He's the Stock Picks editor from Stock Picks here from Benzinga. And today we'll be going over a couple of important topics that Matt would like to cover here for our subscribers and for new subscribers as well, if you're interested. Matt, feel free to take it away.
Great, thank you. I got to, my dog was barking there in the, it's good going, but hold on here. Let's make sure we got it here. There we go. Can you, whoops, let me just get a second. There we go. Okay, yeah, just talk today about the, what I try to do here with the Benzinga Stock Picks report. It's one of the things that, a lot of people talk about is, what's fundamental analysis? How's it go with technical analysis? And one of my big things is that I've been doing for my whole career is trying to combine both of them to really, that enable people to maximize their returns. I mean, one of the things that, I'll just talk about a little bit. One of the things that, I'm also a strategist at Miller Tabak and macro strategist. And most strategists who work on Wall Street are, either former economists or they're former analysts for specific groups or something. So they really talk about the theoretical stuff and what should happen. Having spent 25 years on trading desks and 25 years on two of the most important and most powerful trading desks on Wall Street, Salomon Brothers in the 1980s and 1990s, and then for Merrill Lynch for about 10 years in the last decade. So about 25 years, and again, you get to learn what really is happening and why. And so therefore, what will happen in the future, not what should happen in the future. So many different times where what should be happening doesn't work out. And I think it's important to look, when they say the market is always right. Now that's one of the worst sayings on Wall Street. The market is only always right eventually. And when we've seen it time and time again, whether it be, the stock market was dead wrong in 1999 and 2000, just before the dot-com bubble crashed. But then it was dead wrong on the other way until early 2003, where people were throwing the baby out with the bathwater and presented unbelievable opportunities to buy stock. And the same thing happened in 2007 and at the top then, and then the bottom in March of 2009. And the thing is, people, it takes a while for the markets to, again, there are so many things that go involved in the marketplace. It's just not just fundamental analysis, but it's thousands of different people's opinion on what that analysis should be. And they're constantly trading, and therefore things can go way out of whack because of certain emotions and things get involved. And so that's why we really try to combine them all. And just in my background, I think has made it help enable me to do it in a way that's been very profitable for institutional and for individual traders alike. So let's just talk about, again, some of these things that again, a little bit of a tutorial on the differences. I mean, some of this, for some of you may be pretty elementary, but for others, they're new to the business. We just have to know that the fundamental analysis, of course, is very, very important. We want to know what the kind of company's earnings are, what their future profits are, what their growth prospects are, how do they plan to expand, what are their financials, what are their costs, et cetera, because we really want to make sure that we know that this is something that's going to, we're looking at their future cash flows. That's what investment's all about, and that's where fundamental analysis comes in. However, we talk about technical analysis. Even though they're very different, they are much more similar than people realize. And that's why I like to combine them to really help maximize the returns. But you think about it on technical analysis, you think, well, a lot of people, it's just a bunch of lines drawn on a chart. But it's really not. I mean, think about it for a second. you've heard them, the biggest fundamental person in the world, person who only looks at fundamentals, will still always tell you in the overall market will top out 6 months before recession hits. It will bottom out 6 months before we come out of recession. And they'll tell you the same thing happens with stocks of 6 to 8 or whatever, how many months in advance before a stock, when it peaks, it'll turn down 6 months before the fundamentals turn down, and it'll bottom 6 months or 8 months or 10 months, 12 months before the actual fundamentals bottom. And that's where the technical analysis comes in. Because you think about it, you think about a company, they go out and they've had a tough couple of years. You know, they've been making whatever product and it hasn't been going well. They don't have a new product. Suddenly things turn. Maybe they have a new product, whatever happens to be. But what do they have to do? It's like, well, geez, they've already laid off a bunch of people. They've closed some plants. They've partially closed others. They've got to turn things around. Well, that takes time. You've got to interview people. You've got to rehire people. You've got to retool your factories, maybe build a new one. That doesn't happen overnight. But the reason why you're doing it is because your business is getting better. And the institutional guys who have an army of analysts behind them, they come to their portfolio manager. They say, hey, the fundamentals for XYZ company are really getting good. I mean, their earnings aren't going to get better for another 9 months, but I'm telling you, they are going to get better. So don't wait for the thing to get better. Buy it now. And that's when the real pros get in there and buy it. And the stock starts moving up in advance of that change in the fundamentals. And that's how the rest of us schmucks who don't have those army of analysts can see something like this happening. And the same on the way down. And so it is much more than just a bunch of lines drawn on a chart. It's a way for people who don't have the wherewithal to have 20 analysts working for them. In some cases, maybe hundreds of analysts working for them to help them decipher what's going on. So again, that's what I really talk about. Again, technical analysis based on fundamental analysis. So, but let's just cover some of the the basics on fundamental analysis. I mean, of course, we have bottoms up, which is kind of the traditional one that's the real stock pickers really use. And we all know earnings, of course, are the most important thing to look at. And again, we were looking at discounted cash flows. That's how we wanted to see how things will move in the future. And that's, of course, that's one of the reasons I'm sure you heard lately in recent months that the higher interest rates are hurting the technology stocks, because a lot of their things are further out. They're coming up with a new technology, but it's going to take time. They're not going to get those cash flows until later on. So therefore, higher interest rates are going to eat away at some of that, some of their profits. And that's why we look at that earnings. But of course, earnings can be different for different companies. I mean, you may have two companies, company A and company B. They're both making $100 million. They both do the same thing. So the stock should be at the same price, right? Well, maybe not. Because the one company A may have twice as many shares outstanding as company B. That's why we look at earnings per share, not just their overall earnings. Because if they're both earning $100 million, the other one has twice as many shares outstanding, those are more diluted, you're going to be willing to pay more for company B than company A because they have fewer shares outstanding. And it's the same thing on price earnings ratio is another interesting area, because again, where's the stock? Is it high relative to its future earnings, or is it low versus its relative future earnings? And it changes from group to group. I mean, obviously technology, we know it's going to take longer for them. I mean, a Tesla for whatever, we're looking way out into the future for them to get better. So you're willing to pay for that. So you're willing to take a higher PE ratio for a company that has a little more risk, a growth company. But what about a utility company? Well, their earnings are basically regulated because they have a monopoly, and the government says, okay, you can have a monopoly, but everybody needs energy, so you can charge whatever the heck you want. So we're going to tell you what you can charge. And therefore, their earnings are very much, you're not going to be willing to pay a high price earnings ratio because they can't earn a lot of money. The government won't let them. Now, some people would say, well, why would I ever buy them? Because in exchange for basically guaranteed earnings, they also pay out very nice dividends. And again, when people, you want to have several buckets. You want that one bucket that has that long-term, big bucket with long-term 3, 5, 10-year horizon that you're really using to build that wealth over time. And those are good stocks for that. Highly dividend stocks, conservative stocks, especially if you put them in a dividend reinvestment program, they can build wealth just as you're sitting there owning the stock. If you don't need the dividends, you're working, you don't need the dividend payments to pay for anything, you just reinvest it in the stocks, and it's a great way to build wealth. But the point is that there are different levels of price earnings ratios for different groups and different kinds of stocks. And then price to book value is another one. But the one I do want to say that there's three others that I really look at is that price to sales. And that's a very important one because right now the stock market is at a historic high on price to sales. Price to sales is important because you can't fake sales. I mean, unless you're completely lying and then you're going to jail. You can't fake price to sales. Your sales are your sales. Your earnings, sometimes there's certain write-offs you can do. You can kind of make your earnings look better than they really are. And it's all legal. I mean, good analysts will figure that out. But price to sales, it's, again, for us who don't have the army of analysts, it's a good one to look at. Cash flow, of course, is always a great one. One of the best calls I ever made was in 2019, the summer, June of 2019. People were talking about Apple Computer, and it's like, oh, it's dead money. They're not innovative anymore. And I'm like going, are you crazy? Yes, they're not coming up with the same products they used to, but they spin off gazillions of dollars of cash flow. This stock is gonna go higher, and sure enough, it ran, for the next basically 15 months, straight up from there. I also mentioned debt levels. Not so worried about that right now, but we will have another recession. We will certainly have another correction. We'll have another bear market when they happen, but especially next recession, those with high levels of debt, you want to be very careful about and avoid them because it'll be harder for them to service their debt. And then, of course, you have top down when we look at everything. We look at the U.S. economy, the global economy, the valuation levels that I just talked about with PE ratios and such, broad earnings rather than just an individual company. Are earnings growing? Or are they slowing down? Maybe they're still growing, but they're slowing down. And like what we're facing right now is we're seeing huge earnings growth, but that's compared to a year when we had negative earnings. I mean, it was the economy completely shut down. So you have to be able to decipher which ones are really working. Group selection are very, very important. And that's one of the things I was able to do this year, or actually last year, I started this we started this with Benzinga less than a year ago. So that's why I say it's my first year of being involved in writing the newsletter. But in this first year, we had obviously the big rotation from growth into value. I was pounding the table back way before everybody else on the value stocks, the bank stocks, energy stocks, and stocks like that. It's worked out really, really well. And then, of course, there's certain correlations. I mean, high interest rates. If interest rates are moving up, that helps the net interest margins, the profits of banks to do better. And that's one of the reasons why I saw interest rates turning up, and I turned very, very bullish on the bank stocks. And that's what worked out very well. But again, you want to look at those correlations. There's also a call I've just made just recently on our tier 3 call and tier 4 was the situation where I said Home Depot, it was overbought. I said, this is a good stock to short or even look at some puts in the stock. And people are saying, well, yeah, it's overbought, but it's not as overbought as it was 6 months ago. And I go, yeah, but 6 months ago, lumber was not. And lumber was most overbought. I mean, it was extremely overbought. And there's actually a decent size, it's not a perfect correlation, but a decent correlation between the price of lumber and Home Depot. And so I knew the lumber had no choice but to roll over. And sure enough, it did. It basically, fell out of bed 25% in just a couple of weeks. And Home Depot went down 10% along with it. So these types of things that we're constantly looking at. Again, technical analysis, we already kind of talked about how it's fundamentally based. But what we do notice that most technicians try to capture that middle 70%. Where my specialty comes in through my combining. So that's why you don't want to just use technical analysis. You do want to use that fundamental analysis to try to get the key turning points, because that's really where you get the big juice. I mean, just think about it. If you buy a stock at $10 and it's like, oh geez, I really like it for a number of different reasons. You get it. Nobody gets the exact bottom, but the stock's been coming down. You get a nice bottom in and around $10. And then the stock goes up. Well, mainstream Wall Street, there you always want to play a little cautious. They want to be careful. And thus it gets to $15, they finally turn bullish. That's great. The stock goes to 30. You're like, thank you, Mr. Big Bulge Bracket Firm. You doubled my money. The thing is, when you talk to us, we got in at $10, not 15. We tripled our money. And that's better, as they say. So it's the type of thing that we're using it all. And don't get me wrong, there are times when we miss a bottom or a top. That's okay. It's very hard to get those points, but the work we have to be careful about when we try to pick those ones. If you're trying to pick them all the time, it's a loser's battle. But these type of situations come a lot more often than people realize. But if we miss them, then we look for that confirmation, and then we jump on board when that technical analysis helps us. But just to talk about, for some who don't really follow technical analysis much, We know moving averages is a big thing, that a lot of people watch. The 200-day moving average is key, and I wrote 50 DMA. So you see it on my charts or any other charts. DMA stands for day moving average. So the 50-day moving average, the 20-day moving average is a shorter term one. A lot of people really focus on the 200 and the 50-day. And the 200-day moving average is about a year. I know if you take out weekends and holidays and stuff, it's a little more than 200, but that's the number that people like to use. And 50 days is a little bit more than a full quarter, but again, that's kind of one of the reasons I use that. And I'm going to show you some examples on how following these moving averages in a few minutes can be really very helpful. Well, here it is. I'm sorry. Look at Bank America. This was last year. It kept bumping up against its 200-day moving average. Couldn't break it. It finally broke it. And this is what it was funny, because we had turned bullish on the banks in here, right? And we doubled down when it broke above its 200-day moving average. And look what it did. It just took off. So you can see, for different stocks, it's not always the 200-day moving average. For some stock, it's the 50. And it's very easy to do. This chart just goes back to 2019. You can look back and go back as far as you want. Go back 10 years, 20 years. Oh, how good has the 200-day moving average been for this particular stock or this particular index? And that's what we look for. Then there's trend lines, of course, and they're very, very important. They're fairly obvious. I mean, you have upward sloping trend lines, downward sloping trend lines, and when they're broken, it can really be an important indicator for when that big change is occurring or confirming this is occurring. Now, again, look at what happened in the 10-year note last year. I had turned bullish right in here, okay? And the reason for that, and we'll go over it a little bit more in a few minutes, but positioning, sentiment was just way too extreme. Everybody was on one side of the boat, and I said, this thing has to break out. It has got to bounce here. I think it's going to be a multi-month bounce, okay? However, it made a higher high and then broke above its trend line. And that told me to double down. I said, this is more than just a multi-week, multi-month one. This is going to last a long time. Now, remember, look at it here. It's a very, very important note. Whenever you see a trend, any support or resistance level broken in technical analysis, it has to be a meaningful one. See, this first one was only a very mild one. It pulled back. It wasn't until it became more meaningful that I got more bullish. And then look what happened. Interest rates just took off. And of course, they've come down a little bit since then, but you can see how that broken trend line, see how well it can work. And one of the biggest things, of course, is higher highs and higher lows, or lower highs and lower lows. This is the key to momentum investing. It encourages you can add to positions. It encourages you to hold on to a position. Geez, I bought the stock at $10. Now it's at 30. What am I going to do? Well, geez, first of all, it's not expensive, and it continues to make a series of higher highs and higher lows. I'm going to stick with it. That's the biggest thing about investing. Limit your losses. Whenever I buy a stock, it's a maximum 10% loss. If you limit your losses, and then you let your good ones run. I mean, you always want to have a lot more wins than you have losses, but the way you really maximize it is if when the losses, you keep them to 5 to 10% losses, and the big winners get you 30, 40, 50, and many multiples of percent. And that way the batting average even works more out in your favor. But again, this year's one is Darden Restaurants. It's just been going, and it's been nice higher highs. But what happens is, if you bought the stock down here, we turn bullish on the restaurant industry down here. If it breaks below that low, makes a low, finally changes that trend of higher highs and higher lows and makes a lower low, then I'm going to get out of the stock, take profits. If it keeps going, then I let it ride. It just gives you more confirmation. But again, that's a way to higher highs and higher lows is a way, or in the other direction, as the market's going down and it's making lower highs and lower lows, it just tells you that the trend is in place and it's not changing. When you see that difference, that's when you really want to make the change. Okay, now the relative strength index. I don't want to get too much into this. I don't want to spend too much time on all this technical analysis because I know you guys have a lot of questions and probably want to talk about some different stocks. But this is a key one to look at, a relative strength index, and it basically measures the recent strength or weakness of the stock. And you look at it, I look at it on both daily and weekly charts. Obviously, the daily charts are compelling, but the weekly ones, when they become very overbought or very oversold on the weekly charts, it really tells you that there's probably a change coming in the direction of the stock. Now, above 70, and I'll show you the chart in a minute, above 70, and you'll see there's a red line goes across there. That means stop. red line, stop. It's getting expensive. And it gets below 30, and there's a green line. It's like, hey, buy it. It's getting nice. But do be careful a little bit, because certain stocks that are more volatile, if it gets to 70, like Tesla, I mean, that's had these huge volatile moves. Tesla's not enough to say that's oversold at 70. And it's not enough to say it's overbought. I'm sorry, to say it's overbought at 70. That thing tends to get into the high 80s. So again, you can go back and look at the past, at the relative strength index on the charts, and see what are the kind of the key areas where a stock becomes overbought or oversold. 70 and 30 is the general rule, but for certain stocks, especially volatile ones, it does change around a little bit. But it's been a great thing for us. I mean, look at one of the calls I made, maybe the best call I've ever made here, the relative strength index in Viacom. You know, I blew up with that Archegos situation, but I just looked at this thing and look, every time it got here, overbought, even here, the stock turned down. This time, this got, again, it got a little bit above 70, above the red line, but here it got well above 90. This is when I came in and said, all right, if you own this stock, sell it. Sell 100% of everything you own. This is crazy. As fundamentally, it was ridiculously expensive. Viacom is a great company. It's now a part of my tier 2 top stock picks. I like this stock, but at $100, it was ridiculous. I said, sell the stock and buy puts. These puts, the puts we bought in just a couple of days, went up 2,500%. And that was on being conservative. Some people held it a little bit longer, and they made even more than that. And again, I guess 2,500% in just a few days. So these kind of readings, when they get really extreme, can be very, very helpful. And so you had a lot of people up here saying what we were saying: fundamentals don't work, sell the stock. But we were using technical analysis to say not only sell the stock and take profits, add some puts, and you can really maximize those returns, which is again what we're trying to do. Tesla's another instance on the other way, where Tesla back in 2019, while the stock was trading, let's move that out of the way. You can see where the stock, at the time, this is a post-stock split. But anyway, I started pounding the table, and I was saying, I don't care if you think this company's going out of business. This RSI chart is below 20. It's going to go on higher. It may be going out of business 5 years from now, but it's going higher now. And the stock rallied, needless to say, rallied in a straight line. And I stuck with that for the next year and a half, and it worked very, very well for us. So again, it was a way to find a great entry point into the name, even a volatile name, which can be, obviously very tough. And again, I'll just MACD charts. These are kind of like a golden crosses or death cross. For those who don't know those, a golden cross is when the 50-day moving average rises above a 200-day moving average, and they're both rising. And the death cross is when the 50 crosses below the 200-day moving average. And those are not indicators that a thing is about to change trend. It happens after a trend is already taken and confirms that the trend is taking place. But it is a great opportunity, provides a great opportunity for people to add to positions. So if you already bought a stock at a nice level and then you get a golden cross, it's like, okay, this is confirming the change in trend. I'm going to add more to my position. Okay, and I'll just talk about, then of course there's sentiment. Sentiment polls, I'm sure you heard all about those, whether it be, so individual investors, when sentiment polls get too aggressive, people become too bullish. That's actually a contrarian indicator. It means that there's nobody left to buy. When people get too bearish, there's nobody left to sell. That's actually a bullish indicator. And same thing with positioning. We look at the commitment of traders data. And of course, and that tells you what the futures traders, if they're all long, if they have huge long positions, there's nobody left to buy. It can't go any higher. So it's a contrarian indicator. And the same thing with short interest. I'm sure you've all heard with these meme stocks. Everybody's short the stock. There's nobody left to sell. And these people get squeezed on the way up because those are leverage positions. And these stocks can see huge rallies, as we have seen. Well, one thing I'll give you a few more examples of how I've been able to pull these two together, is the one thing I want to note. Again, I already talked the one golden rule about we make sure we limit your losses. The other one is, don't be afraid to add to your gains. And just like I talked about, the earlier one was you bought it at 10 and the stock goes to 20. Okay. Well, let's say better one. Let's say stock is at $30. Okay. And we put it by. Okay, great. It goes to $40. Gosh, I wish I had bought more at 30. Don't worry about it. Go ahead and buy more at $30. Because guess what? Now you double down at 30 at 40. You bought it at 30. You double down at 40. Your average price is 35. That's where your stop level is now. So if it gets back down to 35, I'm going to sell my position and no loss, because of course Nowadays, you don't have to pay money to, you don't have to pay a commission to buy these stocks, and you're out of the stock, no loss. So you're almost guaranteed not to have a loss, okay? If you buy a stock at 30 and double down when it goes to 20, okay, it's down way more than 10%. Now your average price is, you've just doubled down. Your average price is 25. It's trading at 20. You've just doubled down on a losing position. Now you're basing the rest of everything on hope that it bounces back. Hope is not a good investment strategy. So don't be afraid if you really like a stock, especially if it's making another higher high. Great, I'm going to add some more. We just saw a golden cross. I'm going to add some more to this stock. That's okay. And then use your new price, your new average price as a level where you can use it, what they call a stop out level, will force you to sell, force you to take the profits, and not give away all the gains that you've made. Okay, so let's move on to the stocks that, some of the stocks that we've had that have worked out really well for us. This is a situation where I really like the fundamental story behind Invesco. Okay, this is, remember I talked about how I really thought interest rates would turn. And for a number of different reasons, it mostly had to do with positioning, but I also felt that the economy was not going to stay in the line, would come out of its the pandemic lockdown sooner than people thought, and that of course worked out well. But I also used technical analysis. I mean, Invesco is an investment advisory firm, so they're not a bank, but they are a financial stock, and they're very highly sensitive to interest rates. So I felt on a fundamental basis, interest rates were going higher, this stock would go higher. Then, but look how the 200-day moving average was a key resistance level, kept going up, and look, then it finally broke. When it broke, that's when I turned bullish. Even though I turned bullish in here on the banks, on interest rates, I thought interest rates would rise. I waited until I got that confirmation. It broke above its 200-day moving average, which had been tough resistance, and it broke above a multi-month range. And look what it's done ever since. It's had this huge run, worked out beautifully for us. Here's another, oopsie. Next run, Microvision. Again, a fundamental stock that I loved on a fundamental basis back and here. And then for all levels, but even especially for the tier 3 and tier 4, we've been able to profit. The stock is now up 700%, over 700%, 705, I think, since we bought this at $2.60 here. I loved it on a fundamental basis. Why? Because they have technology for smart glasses, a new display for smart glasses. So they actually look good. They don't, some of those smart glasses, they look like, glasses out of a sci-fi movie from the 1950s. They were ugly, and these don't work. But as Tim Cook said, one of the next big things is going to be smart glasses, because now they can make them fashionable. People will actually wear them and use them and not look ridiculous. And Microvision has got the display that can enable them to do that. But more importantly, they have LiDAR, laser radar. And that's what you do is for self-driving cars, for robotics, for a vacuum cleaner. I mean, the vacuum cleaner's got to it's like a bump into your nice wood, antique wood furniture and mark it up. They have to have that LiDAR technology. It is the wave of the future. So I love it on a fundamental basis. Now here, the stock made a higher high. You can't really see it here because it was such a narrow range, and it shot up. And the stock, like I said, for tier 1, that's been great. It's up 700% in just 6 months. But for the other tiers, if people want to be a little bit more active, and some people own a chunk. I've got Microvision in my long-term portfolio, but I can trade. I also have a portion of it in my active portfolio where I can do some swing trading. And I use technical analysis. The stock within just a couple of weeks, just look at that, it got up to 100. I was like, this is ridiculous. I told people, sell half of what you own. Not all of it, because we still love it long-term, but you sell half. And it gets back down to 5, you should buy it. When it got back down to 5, I said, buy it. We got back in, and it shot back up again. Again, I said, sell half. It's just too good. It's just had too much. It's run too far, too fast. Remember, Amazon changed the world. Unbelievable company, but they've had big dips along the way. And those who've been able to trade around those have made even more money than those who bought it in 2001 and held it for the last 20 years. And then again, we've done the same thing using these analysis here. It came into a buy. Again, I sell half. In this case, I said only buy 25% to take it from 50% to 75%. Then we went to 100% here. Again, it got overbought, got crazy overbought. I said sell half. I didn't mark it on the chart, but we went back, bought it here. We didn't get the exact bottom. Don't pretend to be perfect. We bought it back here. And then just this past week, I said, again, go back to a 50% position. It was getting overbought, not as overbought as that, but it's also one of these, it has a good fundamental story, but it's also a heavily shorted stock. And so it's one of these meme stocks that could, and I think will probably come right back down again. However, it's not like AMC. AMC is a dangerous stock. We've been able to make money on our tier 4 chat room, on both the long side in calls and on the short side in puts. But longer term, I just don't like the stock AMC. It's not one of my picks because they're not going to, they're not going to find the cure for cancer. They're not going to invent the next technology thing that's going to change the world. They may be they may be able to turn things around, but it's going to be a long haul. Microvision does have a long haul, but I just think it's getting too overbought, and we're going to double back up when it gets back down to the 10 level. I think that could happen when these other meme stocks get hit. But like I said, I love it long term. So does the Russell 2000, because the Russell 2000 index just added Microvision just this past week to their index. So that's been a great one. And then just talk about what Microvision has done versus Bitcoin. Obviously, everybody loves Bitcoin, and it's come way off its highs, but it's still up 90% since December 8th of last year. That was the day I picked Microvision. 90% is a hell of a move, but we've made over 700% in Microvision. So again, it doesn't have to be all these esoteric things. We can do it in regular stocks to get things going. And I'm just going to do one more thing here. I don't want to be taking up too much time, but I talked earlier about how it's so important to be early, and you can get so much of your much more gains. Here's the ETF, the XOP oil and gas ETF. Okay, I turned bullish on this group back here. Okay, now you'll see it on the next chart, but back in here. Okay, well, look at these people. The bulge bracket firms, just after the first of the year, they finally turned bullish on it. That's great. They have almost 55% return in just 6 months. That's fabulous. That's fabulous. Schwab and BMO, the old Bank of Montreal, they turned bullish more recently. They're up 8% in just a couple of weeks. That's pretty good. Well, that's fine. But look where I went. I turned bullish here, okay? I stayed with it even though, and everybody else was saying, I would see that rally. It was a big head fake. I said, no. The positioning was ridiculous. Institutions are way too underweight this group. It's going to go higher. Technically, the RSI chart was ridiculously oversold. The daily sentiment index told us the futures traders were short oil and gas. I'm sorry, we're short oil futures in a big way. I turned bullish. Okay, we're up 140%. So these guys, I understand why they have to be more careful. Bulge bracket firms, their whole thing is bringing assets in and keeping it in-house. They don't want to take those kind of chances. I don't want to just take any old chance. We want we want the fundamentals and the technicals and the positioning and the sentiment all to line up together for us. That's what I saw on here, so we can get much bigger gains and maximize our returns. Again, and I've talked about Viacom already. Again, just to talk about the tier, these kind of the best picks. It's not all of my best picks, and I'm sorry, Man Group, that was not 5 weeks ago. Now it's been about 10 weeks. I apologize, but I just wanted to show something that was a little more. That's not my 6th best pick. Oh, I'm sorry. These are all wrong. This is a chart from a previous presentation. I apologize. Microvision is now up 700%. See, this is one I showed earlier. It was only up 400%. Blockchain, I did shut this out at up 150%. This one, which a month ago was up 136%, is now up 46%. Walgreen 48, etc. That's a little. I'm sorry, I did the wrong pick there, but the wrong chart there. When I pasted it in, I did the wrong one. And then for the tier 3 picks, where we use more options, we've had the Viacom has been the biggest pick, but by far. But we've also been able to make some, and some have been puts, and some have been calls. The Ford Motor call was on a breakout, on a technical breakout. Seagate, same thing. Apple Computer, same thing. Sundial was one of those meme stocks. That one was simply because I saw huge amounts of call buying by big players, not just small players, and I said, let's take a flyer on this one. Let's take a lottery ticket. I'm not going to invest a lot of money, but we're going to invest a small amount, and we made 250% in like 3 days. Again, we don't win on all of them. There's been some. We had one on AMC recently that we got out flat. Although we've taken several shots on AMC, we've made 100% on a couple, lost a little money on a couple. And again, I don't pretend to be right all the time, but the key thing is what I try to do anyway. Keep people, limit their losses. You want to be, you don't want to be, a baseball player. He bats 350. He's a major league all-star, man. He's getting paid $100 million. He's going to sign a huge contract, right? If you're batting 350 in stock picking, that's not very good. But you can't bat 1,000 either. So what you want to do is be batting 700, 800, and that's what we've been able to do batting, with our picks, the number of our picks. And then the ones we lose on, we know we're going to strike out sometimes. We know we're going to hit a double play every once in a while, but we don't want that to be a 30% loss, a 50% loss. We get out. Many times it's just 5 to 7%, and at 10%, that's it. We're out. And that way, so that for batting 700 or 800, it's actually even better than that because we're letting those ones ride, like the Microvision and the Invescos and the Glencores. They rally over more than double your money in less than a year, and that more than makes up for the couple of losses we have because, like I said, it is impossible to get them all. Anyway, that's pretty much my presentation. I hope I didn't go on too long. It took about a half an hour there. But if you want to ask some questions, we can talk about some individual stocks, and we'll take it from there.
Sounds good. Great presentation, Matt. So yeah, we have some tickers here on the list. TDOC, first one on the list.
Okay, hold on just 1 second. I'm trying to get out of my, I don't know why I can't get, oh, there it is. Okay, hold on. Hold on just 1 sec. There it is. Okay. Bang. Can you see my Bloomberg now?
Yes, we can see your Bloomberg now.
Perfect. Yep. Okay. So which one what were you asking about?
TDOC, Teladoc, TDOC.
TDOC, Teladoc. Okay. Let's go. Okay. I'm just going to move this out of the way. Okay. Yeah, boy, this stock, it's kind of interesting. I want to look at something else too. This is the RSI chart. You can see it's, it got way oversold, so that presented a great opportunity. But it's kind of neutral right now. It's trying to flatten it out. But let's also look at its MACD chart. MACD chart. Okay, yeah, this looks pretty good. I mean, what the key thing you want to be watching here is what can it do at its 50-day moving average. If you own the stock, especially if you own it down here, you're looking pretty good. It's got stuck in a sideways range, but it's only been 2 weeks, not a problem, and it's just taking a breather. But what I really like about this stock is it made a positive MACD cross here, right? Then it made a lower low. Oh boy, that's not good. But then it made another so we have a divergence here, a positive divergence, and a MACD cross here, and then a MACD cross at a higher low. That's good. Okay, and this is when if it breaks above its 50-day moving average, which right now is at 162.50, that's going to give it even more momentum. So this one, it's funny. If I just looked at the RSI chart, I was like, oh, okay, it looks like it has some upside potential. But the fact that this positive divergence with the positive MACD cross at a higher low, that's going to be, I think, a signal that the stock wants to go higher. And then keep an eye on that MACD chart if you see a negative cross, because we see what happened here when I saw a negative cross. The stock has been dropped pretty good. So keep an eye on the MACD chart. You see a negative cross, that's your stop out level. That's when you say, okay, I'm going to take my profits. And even if it's a little bit higher, I'll take my losses. But right now, this one looks pretty good.
Okay, so if it does cross that 50-day and the 50 MA you have there, how many days after it closes above it would you be confident enough to take the trade?
Well, again, I'm more in days than I am in percentage. What I like to see is about some technicians, again, they're a little bit more conservative, like 3%. I like 2%. You get 2% above that 50-day moving average, and that should confirm that it is indeed breaking out. Mm-hmm. And what I like about this too is, we'll just go back to the RSI chart. If it breaks above that 50-day, I mean, I doubt it's going to get way up like it was here. It could. If it takes a long time for that to happen, then you want to be careful. Then it's kind of in a sideways range, and the 50-day keeps falling. That's not good. But it looks pretty good here. I think when you get that breakout, and again, about 2% above that 50-day moving average, mm-hmm. It's going to signal that it's still got plenty of room to run before it gets overbought.
Okay, we have NVIDIA here next on the list. NVIDIA.
Yes, this has been such a great stock, when I am getting a little nervous about it, only because it's getting overbought. I mean, again, I want to talk about how great it is. I mean, how great companies can see unbelievable, that's too far back. Unbelievable companies can see very big corrections. I mean, Amazon, of course. Amazon has changed the world over the last 25 years. It saw a 90% correction in 2000. NVIDIA is not going to see a 90% correction. I'm not worried about that. But my point is that, but between then after, but even after that, it has seen many corrections between 20 and even 60%, but usually in the 20-30% range when it gets ahead of itself. So, I mean, just because it's a great company doesn't mean it's a great stock all the time. Sometimes it's not a great stock. Now, but look at this. What a great breakout here. You know, okay, maybe, ooh, got a little scared there, got a lower low, but then it came right through a nice higher low, higher high, higher low, bounced off the 200-day moving average and made another higher high. But look at this RSI chart. It's starting to get quite extended. It could go a little bit more, but you saw the last 2 times, and I'm going to put in the date a little bit closer so you can get a better look at it. Bang. There we go. I'm going to get rid of the 100-day moving average so it doesn't clutter up this chart. And you see here, I mean, it's getting towards that level where it's seen, and even here, it's even more of a bought than the last 2 times when it saw decent sized corrections, pullbacks. So again, and the other thing I'm worried about is it's the number 2 stock and weighted stock in the SMH, which is the semiconductor ETF. Look at Taiwan Semiconductor, which is by far the most important. It's down. I mean, it's not acting very well. And there was actually an article, and funny, I did a thing on CNBC. It's on CNBC.com. If you look up CNBC.com and look for and punch my name in, Matt Maley, you'll see the interview I did on Thursday, saying how I'm worried about this stock. And there was a negative article in Barron's this weekend saying the stock is probably going to go to $100. And this, you know, even these guys who like the company. One person has a sell on it. He goes, I like the company, but I don't like the price. It's 27 times earnings versus 19 as his 5-year average. This stock may go, and he said it's going to go down 15%. So this is one of the analysts, one of the leading analysts from an Asia Pacific brokerage firm, and he thinks it's going to go to 100. This one, which is the biggest weighting of the group, goes to 100, and NVIDIA comes down. The semiconductors overall are going to have a tough time. So love NVIDIA, love it long term. Short term, I do not want to be chasing it here. You might even want to consider taking some profits to look to buy it back at lower prices. But I tell you, if we do see a correction in the whole group, I don't know that it'll go all the way down to the 200-day moving average. But look how good the 200-day moving average. It got down to it. March actually got a little below on an intraday basis. See here, but those were head fakes. It looked like, oh gosh, it's going to completely break down. There, twice there. It comes back down for any reason. I don't know that it'll do that now. The whole market would have to probably pull back, but that's going to be a good entry point. $552 as we go over time. That moving average is rising, so that'll be a higher number. But if we do get a correction in the whole market, they could easily, which I think is very possible in the second half of the year, this stock could get down there. It's going to be a great place to re-enter the stock for on your trading basis. On a long-term basis, if you own it, again, you have it, and it's such a great company. Keep part of it in that big bucket that has 3 to 5 years, and just but on your trading active part, you might want to take some profits here. It's probably getting ripe. Maybe not tomorrow, maybe not Tuesday, maybe not Wednesday, but I think in the next week or so, you'll see a pullback in the stock.
Okay, and let's see another ticker we have here from the chat. QS QuantaScape.
Okay, now here's a stock. It's funny because I like that. I'm gonna look at its MACD chart. Hold on one second. Yeah, seeing it's again, it made a cross at a high. It doesn't look like it here, but again, another divergence. They're actually at a higher level. It's really not all that compelling, but if you look at the, hold on one second. Where do I have here? Let's do one other one here. There it is. Add study. Bollinger Band. Add. Update. And I'm just going to go here. These are Bollinger Bands. I didn't get into those because they can be very, this kind of esoteric. Yeah, the stock's right. It's very neutral stock. It's right in the middle of its Bollinger Bands. It's not particularly oversold or overbought on its RSI chart. So it's just sometimes you're just neutral on a stock, and that's what I feel right now. You can't always be really bullish or really bearish on a stock. Sometimes you just have to be neutral. And right now, I'm just going to have to say I'm a bit neutral on this one. Let me just pull up the. I wish I could give you more thing, but what I can say, okay, is that look at the 50-day moving average. It got up. I don't know why the 100-day moving averages are even there. But I'm going to get rid of it. You see the 50-day moving average?
Mhm.
It got up to it there and couldn't break it. Got back down. It just got up to it last week, couldn't break it. If it does break above it, right now that's at 33.40. That's going to be bullish for the stock. And of course you can see it's 200-day moving average. This stock is obviously a new stock. So, it's only been around long enough to have a 200-day moving average for a couple of weeks. That'll be less compelling. But watch that 50-day moving average. You break above that, and then of course the key is going to be it has been making a series of lower highs and lower lows. So if it breaks below its lows here of 23.75, that's what the lows back in May, that's going to be a big warning flag for the stock because it will confirm another lower low in a series of lower lows and lower highs. And that would be negative. So at least you know where the battle lines are drawn. 50-day moving average on the upside, the May lows on the downside.
Okay. And it looks like we're getting several requests for the ticker symbol X, US Steel.
Letter X. Boy, that's a great one. This one's had a great run, and again, this is it's getting a little overbought, and you can see, but gosh, just look how good it looks. The greatest thing about this one is I apologize. It took me 2 seconds to get rid of this 100-day moving average. I apologize. 100-day moving average can be compelling. I don't want to say it's not important, but look at this 50-day. It did get below it, but it kind of was racing. It didn't really get meaningfully below it. This was a time that I was worried about the stock, especially right in here, but it was able to get back. But look at it now. Look in the last few months. Got barely below it one day, didn't even close below that level. Got close to it and bounced. Got down to it and bounced. Got down to it and bounced. Got down and rode it for a couple of days and bounced. Got down. Okay, so now what we're looking for, it's like it's held this a bunch of times. So it looks like it's gonna break out. And again, if you break above that, I'm gonna go. That's the the bar charts. Let's look at the stock on a closing basis. And put those moving averages in. Again, the 50-day, so we can see the 50-day there. But if it breaks above this high, this May high of, let's see here, of 28.81. So you get above 29, especially if you get above 30, it's just going to be another confirmation that another leg another leg in this rally is got more juice in it over the summer. So now let's just look at the MACD chart real quick. I'm sure it's going to look good. Yeah, look at that. It didn't make it. It made another. It's in about the same level, but it just saw another positive MACD cross. This is setting up really well. That basically this moving, the 50-day moving average is moving up. It's going to be at 25 in the next, within the next week or so. That's going to be your stop out level. If you own the stock, if it breaks below the 50-day moving average in a meaningful way, that's going to be a very poor thing. These are the strategies I like to look at right now in a stock like this. If I already own the stock, it gets down to 50, I'm going to buy some more. I'm sorry. If it gets down to its 50-day moving average, I'm going to buy some more. Okay. If it breaks below that 50-day moving average, then I'm going to sell everything. I'm going to get out. Okay. If I already own this, again, the assumption I already own the stock, I'm going to add more to it if it gets above 30. Okay. Because I'm adding to a winning position. Okay, so then I just raise my stop to my average price, and if I don't add any more and it keeps running, you can raise your stop. Doesn't have to be your average price, obviously. If you own Tesla at $50, your stop price better not be 50. It should be much higher so that you can ensure that you get profits. But you see how this strategy works? Just use your strategy. You can buy stock. You can buy stock. You don't just have to buy it once and sell it once. You can buy it. You can add to the position. Portfolio managers do. Institutional people do that every single day. They're adding or paring back on positions all the time. That's how they can maximize the returns. You want to be able to do the same thing. But again, the battle lines are well drawn. $25, the 50-day moving average on the sell side, on the support side. $29 on the upside. You break out to that, it's going to tell us it's going higher again.
Okay, that sounds great.
Even higher, I should say.
All right, all right. Yeah, that's definitely great analysis, Matt. Well, I just want to thank you very much for joining us here today, Matt. It's been a great session. Did you have any other closing remarks you'd like to make here on your end to your subscribers? I know a lot of them are here.
One thing I would just say, just to add at the end here, is that one of the things that we've heard for so many years, or I'm sorry, that if you've been on Wall Street, you've heard for many, many years, and people all have been hearing more of it recently, is that when the individual investor gets involved in the market in a big way, it tends to be a top in the market. And that history has borne that out. It happened in 1929, happened in the early 1970s, happened in 1999, 2000. However, the problem is that they kind of lost when the market did finally see a correction, a deep correction. They kept trying to get buy on the way down. They got burned. What I try to do here is help people, instead of, we hear so much from Wall Street saying, we want to help you weather the storm whenever there's a problem. I want to help you weather the storm within your big bucket portfolio, but in your active portfolio, I want you to make money. I don't want you to weather the storm. I want you to profit from the storm. And today, unlike they had in the last three examples I mentioned, there are ways to do it. In the old days, there were no inverse ETFs. There were no leveraged in ETFs, leveraged in ETFs that people can use now. They're very easy to buy and don't cost you no commission. Options do still have commissions tied to them, but you can buy. There's a lot more options. In the old days, you had options that were always 3 months apart. Now they have, the S&P 500 on the NASDAQ, which is the QQQ ETF. You can buy options. Their options expire Monday, Wednesday, Friday, every week. So they don't cost you a fortune. They're not 3 months out. So you can buy them and hedge yourselves or try to profit from a downturn. And for active stocks like Apple Computer, they have options that expire every week. Most do. Now, I say most stocks have options that expire every week. Some of them aren't as liquid, but the big ones do. And so therefore, you can profit on this. My point is that the opportunities are out there. The tools are there that weren't there before. And I think that the market's going to see a correction next year. They see one almost every year anyway. But interest rates, the Fed is talking about tapering back on their QE program. At some point down the road, that's going to have an impact on the stock market. That will be normal. That will be healthy. The thing is, we want to take advantage of it, and we want to keep our heads while others around us are losing theirs. And we can really, when they're getting margin calls, we're going to be making profits. And then when they've sold at the bottom, we're going to be buying and really be able to take advantage of the next upswing.
Right, great, absolutely. Well, thank you very much for your time, Matt. I appreciate it, Matt. It's great to hear from you, get your insight on this, and hope you have a great weekend. I'll stay here answering a couple questions, making sure. Yeah, absolutely. Thank you, Matt.
Thank you.
You're welcome. All right, guys. So I just want to throw in here the link so that you can sign up for Matt Maley's tiers for the stock picks. So that's going to be, it's going to have tier 1, tier 2, and tier 3. On tier 1, you're going to receive 1 pick per week. On tier 2, you're going to receive tier 2. I'm sorry, on tier 2, you receive 1 pick every week. On tier 3, you receive 3 to 9 picks per week. Plus, you get a bonus conference call with Matt Maley himself for tier 3. It's 3 times a week, Monday, Wednesday, Friday. It's at noon. That way you'll be able to, get direct feedback from Matt about the markets and any sector trends that he's looking at. During his regular trading day. As you know, he is a chief market strategist down there at Miller Tabak. So he does have a lot of great insights for you guys. Let me answer a couple. And also the tier 4, it's the chat room. We do have a chat room with Matt Maley. In that chat room, you'll be able to go over any specific trades that you might have, request feedback from Matt Maley himself. You're going to take a look at what he's seeing as far as like intraday and swinging trade ideas that he's looking at. As you can see, Matt Maley is able to trade choppy markets, bear markets, bull markets. So he's very well prepared for this. Let me post the link here one more time. If you have questions, feel free to put them out there. I'll try to answer them as best as I can. Will the recording be shared with us? Yes, everybody that registered will receive a recording of the webinar. That is correct. the prices for the different tiers. All the prices do include a 30% discount. So if you do sign up with this link, special for today, you're going to be able to receive 30% off Matt Maley's picks. And anything tier 4 for the chat room, feel free to give us a call as well if you have any questions. We'll be able to work something out for you with that as well. So I'm including here the link a couple more times. He was using Bloomberg, Tom, for his charts. Matt has a Bloomberg terminal. So that's where he gets most of his data, his analysis. Obviously, there's other people that helping, but that's where he gets his direct charting and tools from. He also uses Benzinga Pro, which is also a great feature here that you can get with us. It has the same features, right? You can look into stocks, get a whole bunch of data on your companies as well. Any student discounts? I'm not 100% sure, but if you definitely reach out, we'll be able to get that addressed, Igor. Okay, well, if you guys have any other questions, feel free to reach out. I'm going to leave here a number where we will be able to provide you guys some support today. And in case you have any questions or need help signing up. The 97 LE is the tier 1. Correct. That's 1 pick per week. That's the starter. We mainly recommend getting the starter and the enhanced, because that way you'll be able to, you'll get, with the starter, you get 1 pick every 2 weeks. And with the enhanced, you get 1 pick every week. So at least during the 14-day money back trial that you'll be able to at least get, more than 1 pick to make a better assessment of the subscription. But as you see, Matt Maley's returns, they're they're pretty consistent. They're very well. So we highly recommend tier 3, because that way he kind of wraps it up there on the tier 3 strategy elite, where he does the call. He wraps up everything there for you. And the link I sent you will take you to the tier 1. Once you get to tier 1, you'll be able to sign up for tier 2 and tier 3. Correct. So you sign up for tier 1, 2, and then 3. Yeah, so the tier 1 only includes 1 pick per week. If you do upgrade to the enhanced, you'll get 1 pick every week. The starter is 1 every 2 weeks. Okay, guys. Well, thank you very much for joining us. I definitely wanted to give you guys a big shout out for being with us here on a Sunday, learning while you're earning. If you have any other questions, feel free to reach out to us. I'll put out the number again one more time in the link. And besides that, I hope you guys have a great weekend. Thanks.